Hey guys, what's up? In this training video, I'm going to walk you through what credit spreads are, how they work, and how to implement step-by-step a strategy that can give you a 71% win rate while risking one to make one. So if you know anything about probabilities, this is a no-brainer trade that you should be taking every single day. Why? Well, because 7 out of 10 times you're going to make a dollar, 3 out of 10 times you're not. So you're going to end up making a lot of money. So let's walk through how this works step by step. So number one, we need to understand credit spreads for those who don't. So simply put, let's say we're going to trade a put credit spread. This means that we want a stock to stay above a certain level. So let's say the stock, this is a stock trading, and we say, it looks like the stock should stay above this level. Well, we simply put on a credit spread trade where the stock is supposed to stay above this level. If it does, we make money. So what does this mean? It means that if the stock goes up, we make money. It means the stock stays the same, we make money. It means that the stock goes down but doesn't break our level, we make money. The only way we lose money is if the stock goes below the level that we pick. Still, this gives a high chance of making money. Why? Because we don't really need to be correct on direction. We just need to be correct on the general idea of where it should go. The same thing works for a call credit spread, but in reverse. So again, we pick a level we think the stock will stay below. So if the stock is trading like this, we pick a level, we think, hey, I think it's going to top out here and it won't cross above. And so we make money when the stock goes down with the call credit spread, when the stock stays the same, or when the stock goes up but stays below our level. We only lose money when the stock goes above the level that we picked. So again, we put credit spreads. These should be traded in bullish markets. We have call credit spreads, and these should be traded in more of a bearish market, because that's how they generally make money. So we don't need to know direction with credit spreads trading. We don't need to know advanced charting. We don't need to know all this. We should have a general idea of where things will go. And we can use simple indicators like moving averages to tell us this. So there's no guessing, no wondering. We just go, is the stock above this indicator or not? Okay, this is the trade I'm going to put on. Anyways, we'll walk more through that in this video later on. Okay, cool. So now, how do we collect certain credit and actually set up these trades? Well, when we set up a trade, what we're doing is we're selling one option at a level. So let's use the put credit spread for example. So we're selling an option at, let's say the stock is trading here being $400. I think the stock will stay above $395. Okay, so this is my level that I want the stock to stay above. Well, how do I actually set up this credit spread trade? Well, I would sell the strike price at $395, and then I would buy the strike price right underneath it at $394. Why? Well, because the way that credit spreads work, when you sell an option, you receive money. When you buy an option, you give up money. So the strike price is closest to the stock price will have more credit. So just in general, let's say I collect, by selling this one, I would collect $1.50. So that means someone would pay me $1.50 to put this trade on. And for this strike, I would have to pay, let's say, $1.10 to put this trade on. And so the difference is what I get to keep. So I would get to keep 40 cents. Now that may not seem much, but when we're in the options world, you multiply everything by 100 to get your real value. So I would make $40 to put on this trade. So I make 40 as long as the stock stays above $395. So that is how you structure a call credit spread trade. Now let's talk about some specifics. Okay, what does 40 cents actually mean? All right, well, let's do this little chart here where we have this little line shows where the stock can go. Let's say the stock is currently trading here. This is where the stock is trading. And this is where my strike price is, right? The stock can go, I guess it can't go to infinite, but it can go to 0 here, and it can go to an infinite amount of price here, right? Okay, so we have the put credit spread strike price here, and this is where the stock's currently trading. We want the stock to stay above it. So how do we know what different credits mean in our probability with it? Well, in the middle here, because a credit spread, the credit you collect, shows the likelihood that you're going to make money with that trade. So for instance, if we're in the middle here, if we're at our strike price, what is the probability that the credit spread stays above our level if it's at the strike price? Well, as anything in the market, it's 50-50. Why? Because it has an equally likelihood chance of staying above or also staying below, because it's in the middle. So in the middle here where your strike price is, the credit spread will be trading at 50 cents. What if the credit spread is, or what if the stock went down to 0? Where would the credit spread be trading? Would it have a likelihood or a good chance of coming back to being at the strike price? No, it would be virtually 0. So the credit you would collect would be around 0 because it's super far away from the strike price. Now, what about moving up further and further? All right, let's walk through some simple credit spread probabilities. All right, let's walk through some simple credit spread probabilities. So let's say that we have Let's walk through some simple credit spread probabilities. So again, a stock can only go as low as 0, but it can technically go an infinite amount of price. So let's say this is where a stock's theoretical price can look like. It can go down to 0, or it can go to infinity. Sweet, cool. Let's say we selected our put strike price right here. Let's just give this a random value. Let's say it's 400. We think the stock will stay above, and the stock's currently trading here. Let's say it's 407. Okay. So we have the stock price. This shows where the stock price can go. This shows our strike price. And now let's talk about probabilities based on credit collected. I'm going to keep this super simple. Okay. If the stock is trading at 400, what is the likelihood that the credit spread is going to end up above the strike price or below the strike price? Well, like anything in the market, it's 50-50. When we are at the strike price, there's a 50% chance that it goes above, also a 50% chance that it goes below. So there's a 50% chance. That means that the credit spread for $1 Y will be trading at 50 cents. So this is where it'll be trading. Now, what if the stock goes down to 0? What is the likelihood that will be above the strike price by expiration? Super unlikely, right? Like it is virtually impossible for the stock to go from 0 to get above 400 by our expiration date. So since the probability of it actually making money for us is unlikely, it's going to be almost 0% chance here. So that means it's going to be trading at roughly $1 because it's not going to happen. If it's not going to happen, then you're going to have to pay out or lose your money on your credit spread. So the credit spread will be trading at a max loss of $1. Here in the middle, it'll be trading at 50 cents. So can you guess what it would be trading at infinity? When the stock is 100% certain that it's going to be above your strike price? Well, if it's 100% certain, then that means that it's going to be trading at 0. Why? Because 0 is how you win. You make money when the credit spread decreases in price, aka moves away from your strike price, and that's how you make money. So what does, if this spread is trading at, let's say, 35 cents, what does that tell us about the probability roughly of this trade? Well, it tells us there's a 35% chance that it expires in the money. So what we do is we take the width, $1 minus 35 to get the opposite. So it gives us 65. That means there's a 65% chance that this stock will expire out of the money, expire worthless for us. That's a rough math with probability. Now, why does this matter? Well, if you know anything about what I've done in the past, I created a free course called 84% Win Rate Course that walks you through how you can follow the trend on stocks like this. And when you follow the trend and you go 3% out of the money, what you can do is you can trade credit spreads and do so with an 84% win rate, risking $3 to make $1. Well, what happens if instead of going 3% out, we move the strike price closer? And if we move the strike price closer, we have a less odds of winning. But as you can see here, we collect more, right? Because the further away we go, the less money we collect. So we're collecting 35 cents around here, but around here, which let's say is roughly 3% out, we're only collecting 15 cents. So is it better to collect 15 cents and have a higher win rate, or collect 35 cents and have a lower win rate? Well, that's the strategy I'm walking you through here today. Okay, so first off, we're still using trend following ideas. If you want to learn more about what I look for in trend follow, you can go check out my free course linked in the description. But essentially here, we're going to go to indicators. We're going to add a moving average, simple moving average. So right here, moving average simple. We'll go here. We can change it to anything we want, but I like the 50 MA just to give me a general idea. Here we go. If the stock is above the 50 moving average, then the market's considered bullish. If it's below, it's considered bearish. So what do we know about credit spreads? Well, if it's above this line, we'll be trading put credit spreads. If it's below the line, we'll be trading call credit spreads, just in general. All right, so now that we do that, with this new strategy, we're gonna go 1% out of the money. So again, the stock closed here at roughly, where did it close? It closed at 44924. So 449. Let me bring this into a second. 44929, and we're going to go 1% of the money. That's going to be 0.99. So that's going to give us 444.79. We can't trade a strike price that has decimal points, so we're just going to round to the nearest whole number. So $445 is the put credit spread strike we're going to sell. Then we're going to buy the one right below it, so the 444. So that's how we would structure this credit spread trade. We would simply sell the right here 445. And buy the 444, and as long as the stock stays above this level by our expiration date, we make money. Boom. So that's how you look at and structure this trade. Let's talk about these specifics though. So we look at the close price, we take and go 1% out, so we're going to multiply that by 0.99 and then round to the nearest whole number, and then our expiration date is simply going to be plus 7 days to what the current date is, and then round to the next Friday. This is how you figure out your expiration date. So for today, for example, it is September 6th. So September 6th plus 7 gets us 13. So September 13th, which again would be next Wednesday, but we're going to round up to that next Friday. So that would be 2 more days, I think. So that would be the 15th. So that means that if today is September 6th, and that means that our expiration date we're picking will be September 15th. So that is kind of a look at how we pick our expiration dates. This is our expiration date. We now know how to pick our strike prices, which for this example is going to be 445, 444. So now we know how to set up these trades. Okay, cool. So if we're setting up this trade right here, we will be collecting around 25 to 30 cents, roughly, depending on volatility. All right, let's take the low end. Let's say when we set up this trade, it's trading at 25 cents. What does this mean? Well, we are deploying and using the same rules from the 84% win rate course, which means that we enter during trending markets, as I just discussed, right? If the market's above this, we're doing a put credit spread. If it's below, we're doing a call credit spread. But also, we look at exit rules, which means that when the stock breaks our short strike price, right here, our short strike price, then we close the trade out early. Why? Well, because it prevents us from assignment risk and a lot of crap that can happen in the middle here. So instead, we just sell here. Again, we know what the price point will be at this level. It'll be theoretically 50 cents. It's typically around 45 though. So around 45 to 50 cents, we'll be able to close the trade out. So that means we stand to make $25 and we are risking, well, again, we'll be able to sell it at, let's say 50. That means we're risking 25. So for rough numbers, we're risking $1 to make $1. And we have roughly a 70% win rate. Okay, cool. So we know this. We know the structure of the trade. We know our math. Now, what is the long-term expected return? How does this work, and how does it compare to using a win rate that's a bit higher? Okay, well, our long-term win rate is our win rate, so 70 times the amount we win per trade, minus the amount we lose, 30. Again, we do this out of 100 trades, so 100 times 70%. That's where the 70 number is coming from. So 70 times 1 times, or minus the amount we lose, I mean the number of times we lose times the amount we lose. So this is simply 70 minus 30. And what does this give us? But a positive 40. Wonderful. Let's look at the other strategy. 84% win rate. Okay, so we win 84 times out of 100. How much do we win when we win? Well, we win $1. So how much do we lose? Well, we lose 16 times. So we lose way less than this one. But we lose $3 for every time we lose. What is the math on this? Well, I don't really want to try to do that math in my head right now, so we'll just do the math. 84 times 1 minus 16 times 3. That gives us 36. 36. So long term, which one is better? Well, obviously, we have a $40 expected return here and a $36 expected return here. But again, at the end of the day, it comes down to this is not a huge difference. Yes, if you're speaking mathematically, which one works best? It's this one that's closer to the money. But you also have to consider your emotions. Do you want to have a 70% win rate, or do you want to have an 84% win rate? Are you okay with, do you want to lose less, or do you want to lose more? This is a personal choice. I just wanted to walk you through how credit spreads work, how the system works, how moving your strike price affects your probability of winning and the amount of credit you collect. And so again, this is the strategy though. 99%, 7 days, round to the next Friday, collecting around 25 cents. This is the 70% win rate strategy that I put together. So again, if you are trying to trade credit spreads, if you want a 70% win rate, if you want to make a long-term positive return, this is the strategy for you. So anyways, guys, I hope you enjoyed this training. That's all I really have for you today is how to, all I really have to do. I just put together a huge in-depth training for you. But anyways, I hope you enjoyed it. If you learned anything from it, smash that subscribe button and share this with a friend who's trying to trade credit spreads but having a hard time. This should explain it all. Anyways, if you still have any questions, put the comment down below. I respond to all my comments, or at least I read them all. So again, I would love to help you if I can. All right, guys. See you in the next training video.